Warm welcome you all. In this video, I am going to give a brief note about portfolio management. Let us see what is portfolio management. Portfolio means a combination of financial assets and physical assets. The financial assets are shares, debentures and other securities, while physical assets include gold, silver, real estates, rare collection, etc. Next, we are going to see about the definition of portfolio management. Portfolio management is the process of selecting a bunch of securities that will provide the investing organization a maximum yield for a given level of risk, or alternatively ensures minimum risk for the given levels of returns. Next, we are going to see about the portfolio management process. Portfolio management is a complex activity which calls for a sequence of steps to be followed carefully. It consists of the following steps, that is, identification of objectives and constraints, selection of the asset mix, formulation of portfolio strategy, security analysis, portfolio execution, portfolio revision and portfolio evaluation. Next, we are going to see about the steps one by one. That is, the first step in the portfolio management process is identification of objectives and constraints. The first and foremost step in the portfolio management process is the identification of objectives and constraints. The investors are to be specified. In the first place, the objectives may be income, capital appreciation, or a future provision for contingencies such as marriage, education, etc. While ascertaining the objectives of the investors and their priorities, the constraints arising out of liquidity, time limit, tax and special restrictions must also be identified. The next step is selection of the asset mix. It includes the selection of various assets to be included in one's portfolio. Asset mix means the proportion of stocks and bonds in the portfolio. A proper mix between stock and bonds depend upon the risk tolerance and investment limit of the investors. The third step in the portfolio management process is the formulation of portfolio strategy. After certain asset mix is chosen, the next step in the portfolio management process is formulation of an appropriate portfolio strategy. There are two choices for the formulation of portfolio strategy, namely an active portfolio strategy, that is to earn a superior risk adjusted return, a passive portfolio strategy holding a broadly diversified portfolio and maintaining a predetermined level of risk exposure. Fourth step is security analysis. Under security analysis, investors actively involve themselves in the selection of securities. Security analysis require the sources of information on the basis of which analysis is made. The securities are analyzed from the point of view of their prices, returns and risk. Security analysis involves both micro analysis and macro analysis. For example, an analysis of only one script is called micro analysis of a company. Macro analysis involves an analysis of market securities. Next step is portfolio execution. It is related to buying and selling of securities. The portfolio execution is an important step in the management of portfolio which has a bearing on investment results. Sixth step is portfolio revision. that is investment activity, starts with a selection of scripts to be included in the portfolio. But the portfolio, one constructed, requires constant monitoring and revision. Change in the investor's financial attitudes, his preference, and market conditions will also necessitate changes in portfolio composition. Last step is portfolio evaluation. The performance evaluation is concerned with assessing the performance of the portfolio over a selected period of time. In the evaluation of risk and return criteria, quantitative measurement of actual return realized and the risk borne by the portfolio over the period of investment is called for. These have to be compared against the objective norms to assess the relative performance of the portfolio. That is the picture example for the performance evaluation. Next, we are going to see about the factors contributing to the portfolio management. The following are the factors that are to be considered for the portfolio management. The first and foremost factor of portfolio management is planning, supervision, timing, conservatism and rationalism, close monitoring and performance. Planning. The first and foremost factor contributing to the portfolio management is planning. While preparing a list of securities for portfolio, due consideration should be given to the investment needs for an investor. Strictly speaking, the plan for portfolio management should reflect the investor's needs. For example, if the investor gives priority to higher income on his investment, then the management should select the income fetching securities. Proper planning in portfolio management not only fulfills the investor's needs but also averts the risk involved in the investment as well. The second factor is the timing of, that is supervision. While undertaking investment plan should pay an attention with regard to the supervision. Third factor is conservatism and rationalism. While making an investment decision, the investor should be conservative and act rationally. The risk involved in an investment is measured statistically by the degree of variance of returns. There is also risk involved in timing period. Risk also arises due to interest rate variability purchasing. Fourth factor is close monitoring of shares. An effective portfolio management is one which identifies the investor's objectives and secures them. As business conditions keep on changing, the performance of portfolio should be effectively supervised in order to bring benefits to the investors. Fifth factor is performance appraisal. Portfolio managers should continuously evaluate the portfolio performance. Managers have to evaluate the portfolio so as to measure their performance in the light of their investment strategies, income, capital appreciation, risk and returns, etc. Constant performance appraisal enable the investor to minimize the risk and improve the yield. Next, we are going to see about the objectives of portfolio management. The first and foremost objective is to maximize for each and every investor the main objective of the investor is to maximize the return and minimize the risk. But in practical, we are going to see about the other objectives, that is security or safety of principal, stability of income, capital growth, marketability, liquidity diversification and favorable tax status. Let us see one by one in brief. Security or safety of principal. Security not only involves keeping the principal sum intact but also keeping intact its purchasing power intact. Safety means protection for investment against loss under reasonably variations. In order to provide safety, a careful review of economic and industry trends is necessary. In other words, errors in portfolio are unavoidable and it requires extensive diversification. Every investor wants that his basic amount of investment should remain safe. The second objective is the safety of capital stability of income so as to facilitate planning more accurately and systematically. The reinvestment consumption of income is more important. Next objective is capital growth. This can be attained by reinvesting in growth securities or through purchase of growth securities. Capital appreciation has become an important investment principle. Investors seek growth stocks which provides a large capital appreciation by way of rights, bonus and appreciation in the market price of a share. The next objective is the marketability. In this case, it is a case with which a security can be bought or sold. It is essential for providing flexibility to investment portfolio. The next objective is liquidity, that is nearness to money. It is desirable to the investor so as to take advantage of attractive opportunities upcoming in the market. Next objective is diversification. The basic objective of building a portfolio is to reduce the risk of loss of capital and or income by investing in various types of securities over a wide range of industries. Next objective is favorable tax status, that is tax incentives. The effective yield an investor gets from his investment depends on tax which it is to subject. By minimizing the tax burden, yield can be effectively improved. Investors try to minimize their tax liabilities from the investments. The portfolio manager has to keep a list of such investment avenues along with the return risk profile, tax implications, yields and other returns. Investment programmers, without considering tax implications, may be costly to the investor. Okay, thank you.